we're here at the 21st Lipper Fund Awards with Third Avenue Management. You guys are the recipient of the Lipper Fund Award for Best Equity Funds Offering Small Company. I have with me two portfolio managers, Victor Cunningham, Small Cap Value, Ryan Dobratz, Real Estate Value. Let's get into it. First off, congratulations.
Thank you.
Thank you.
Victor?
Yes.
What about your investment process separates, these two funds, your fund, from the rest of the classification?
Well, Third Avenue has been around. We've been practicing Marty Whitman's philosophy for over 30 years. And all the investment professionals at Third Avenue share that philosophy. And what differentiates us from the crowd is we're a balance sheet focused firm. Many of our peers look at the income statement. We really start with the balance sheet and really look at how companies can compound wealth over time. And it's an investment philosophy. And I think what we've seen over the past couple of years, and it's really helped our clients, is that especially in the 2020, 2021 period, investment turned to speculation. And we're not speculators, we're investors. So the performance we've generated since that period, which was not like anything I've seen in my career, was that we benefited by what we did, but we also benefited by what we didn't do. And by avoiding the hype and avoiding the crowd and sticking to our discipline, we were able to deliver returns for our clients.
Yeah, thanks. And Ryan, maybe, the past 2-3 years, it's been a crazy market. We've gone from 2020, 2021, 2022, interest rates skyrocketed, fell. What have you learned about your firm, your strategy, or maybe just the real estate market over that time period?
Yeah, in terms of what we learned, it was quite a bit, but it actually really confirmed a lot of the long-held views that we've had at Third Avenue. On the firm side, as Vic kind of alluded to, we've long been balance sheet first. We've always been investors that look down before we look up to protect the downside. And by doing that during that time period, we protected our clients' capital and then ultimately participated in the rebound in a lot of situations. So that was sort of confirmed. And then on the real estate side, one of the things that was really confirmed in the last kind of 3 to 4 years is that we have this really unique strategy that allows us to invest in a much wider set of real estate companies than you might find in a traditional real estate fund, which is constrained to only investing in REITs. So coming out of the pandemic, there were a lot of really interesting opportunities around single-family housing. And using that flexible mandate, we were able to capitalize on those opportunities, and it really provided some separation. So that flexible mandate is important, and that was certainly confirmed.
Thanks, Ryan. So, small cap value, real estate, two asset classes, typically tied to the movement of interest rates. I'm curious, Victor, what specific fundamentals were you and your team looking at during the past rate hiking period, and maybe talk about what is to come. What are you looking at next year as we enter a period where interest rates might start to decrease?
Yeah, so the interest rates certainly create a lot of movement across where money is flowing and things like that. And I think one thing that our firm did a really nice job of over the past 5 years is instead of going to where money was flowing, it was really moving to where money was scarce. So, for example, our real estate team had identified years ago the underinvestment in single-family real estate. Now, that's kind of obvious today, but it wasn't 5 or 10 years ago. So we were deploying capital back then, which has generated good returns. Things like energy. 5 years ago, renewable energy was hot. A lot of money was going in there. Instead, we thought conventional energy was underinvested in. So we deployed our capital there and generated good returns. And then finally, the Small Cap Value Fund, we wrote a letter to our investors back in June of 2020. And we talked about this paradigm shift in terms of government spending. And we tried to anticipate where we thought that money would go. So we invested in firms that benefited from healthcare spending, firms that have benefited from utilities, the hardening of the grid and things like that. So those types of investments, those industrial services businesses and energy businesses and real estate businesses have generated returns, but it was putting money to work when other people really weren't thinking about it.
Yeah, I mean, it's clear you've managed that period very well. That's why you're here. That's why you received the award. So where is that money? Where is that money not going now? What areas are you looking at as drivers of these two classifications going forward, small cap value or real estate?
Yeah. I mean, to the extent that rates are declining, that could certainly spur some additional interest in real estate, small cap value, et cetera. But we're operating with the view at Third Avenue that even if rates do decline, they're still going to be higher than what we've experienced kind of over the past 6 to 7 years. And so we think that there are certain themes that are going to be driving factors going forward that also worked in the last 4 to 5 years. And that is, at least on the real estate side, very much a focus on well-capitalized businesses that own high-quality assets and have low debt levels. And so they're not having to refinance debt at higher rates, ultimately leading to an increase in interest costs. And also, over the past few years, we've really been focused on strategic real estate businesses or platforms that have pricing power so that they're able to drive higher revenues, higher cash flows, and ultimately higher earnings, even in the face of higher rates. So, those two items we're going to continue to focus on. But, in the next kind of 3 to 4 year period, two other opportunities that we think are really interesting on the real estate side. One would be real estate services. Given all the volatility in the capital markets over the last 2 to 3 years, people have put a lot of leasing decisions on hold, a lot of refinancing, a lot of investment sales decisions on hold. But to the extent that the capital markets do settle a little bit, those transactions will come back to market. And so some of the leading real estate services companies like CBRE, JLL, Savills, all of which we own in the Third Avenue Real Estate Value Fund, should prosper. And then the last one that I would mention, looking out over the next 3 to 4 years, we think that the international real estate companies will play a bigger factor in driving returns. A lot of the international markets have certainly, lagged what we've seen here in the U.S. The valuations are incredibly compelling. Some really interesting businesses. So we think that you'll certainly need to focus on some of the international opportunities ahead if you want to provide differentiated returns.
Yeah, thanks, Ryan. That's what I want to hear from my active manager. I think so much has been made of passive index investing. It's low cost. Obviously there are benefits there. But maybe Victor, maybe hit on a couple points of what's the benefit of active investing? Especially at Third Avenue. What is your firm's value add from that standpoint?
Yeah. We're differentiated. If you look at the active share across all of our product platforms, it's close to high 90s across, because I like to tell our clients that we grade differently than our peers, in that we are so focused on the balance sheet and we're so defensive oriented. And I think that often leads to different conclusions than many of our peers. And I think what's happened in the passive space, and I think our two products, real estate and small cap, it's less picked over than, say, large cap value or large cap. So the opportunity set is more fruitful. And if you see the flows that have taken place in small caps, 50% of the assets in small caps are now passive. But what's happened because of that, a lot of companies in the passive index, the quality of the index has deteriorated. 40% of the companies in the Russell 2000 don't make any money. Leverage levels are as high, historically high levels. So I think it's really important, more important now than ever, if you're going to get into small caps, which have a valuation discount as a group, that you need to do it more in an active way, because there are a fair amount of landmines in small cap indices.
Yeah, no, that's a great point. And some of those small caps that do graduate too. I mean, those passive funds have to get rid of them.
Yeah.
Last question. We're here for the Lipper Fund Awards. I'm excited to grab a beer with both of you upstairs later on tonight. But what does a Lipper Fund Award, especially a fund family award for best equity small company fund, what does it mean to your firm, maybe your teams,
Yeah.
Or maybe the strategy itself.
Yeah. Well, it means a lot. In terms of what it means to the firm, Third Avenue. Our clients look to the Third Avenue funds as an alternative that can provide superior risk-adjusted returns over the long term. And winning this award recognizes just that. And it isn't just across one of our individual strategies, but value, small cap, and real estate. So this is an award that we're all incredibly proud to receive. And then on the team side, it also reaffirms that this unconventional balance sheet first approach that we practice is as relevant as ever. Like Vic said at the onset, we've been practicing this for more than 35 years in a period of very low interest rates. We certainly looked out of step, but it is a time-tested approach, and it's one that works over the long term. So to have that reaffirmed is certainly quite positive. And the other thing I'll mention in terms of what it means to the team, we have a really terrific group of people at Third Avenue. The core group has now been working together for the better part of 2 decades, and the collaboration amongst the teams is probably the best that it's ever been. And I think that shines through by getting the recognition from Lipper at the firm level.
Well,
yeah, if I could add to that,
Yeah,
I mean,
go ahead.
I agree with everything Ryan said, but listen, it's first an esteemed organization like Lipper recognized us means a lot to our firm and to all of our employees. But our strategy does work over time, and that's been proven, but it doesn't work all the time. And for true blue value people like us, trying to operate in an environment where there was really no cost of capital or negative cost of capital, it certainly wasn't a positive for our strategy. But now we have a cost of capital that hopefully will be more normal over the next 5 to 10 years. It is affirming, but it's also gratifying to know that you believed in a philosophy and you practiced it when it wasn't very popular. But to stick to that and be rewarded and have a firm like yours recognize us means a lot.
Well, I can't thank you guys enough for being here. I'm looking forward to celebrating with you both. You guys are just 2 of the firm's strategies, but I looked at the overall performance of the other strategies.
Yep.
It was very strong. So thank you. Thank you for I'm sure your investors thank you as well. And congratulations.
Yeah.
Thank you very much.
Thank you so much. Appreciate it.